Good morning and welcome to day 29 for financial accounting for the fall 2021 semester. Today is our last day of new material. Tuesday is officially day 30 of class, but as you've heard already, there will be no formal class. I will be available. I'll be here on campus, on the Olean campus, and I will be available on Zoom if you need me. If the Zoom connection gets dropped due to inactivity and you want to reach me, you can try logging into Zoom. It'll send me an email to let me know that you're in there, and I can log in. Otherwise, you can always reach me by email if you have questions, if there's anything you want to talk about. So we'll be finishing up our final chapter for this semester, chapter 14. We'll be finishing up today. We will pick up with exercise 6 in chapter 14 in just a couple minutes. So the chapter 14 exercises should be submitted for grading by the end of the day today. And then the chapter 14 problem, the due date is Tuesday. Once we finish the chapter today, though, you're welcome to do those remaining assignments at your convenience. If taking them right away is best for you, that's perfectly fine. Everything is available for you in CNow. After the chapter 14 problem, 2 assignments left. The last exam, which just covers these final 3 chapters, 12 on stockholders' equity, 13 on the cash flow statement, and then 14 on financial statement analysis. Along with that, then, the final piece of the project on those same 3 chapters. The deadline for submitting any work that you want included in your final grade is Sunday the 19th. I would be perfectly happy to have you submit it earlier than that, but that's the last possible date because final grades are due on the 20th. After the 19th, anything you have not yet submitted, as I've indicated in the announcements, will turn to a 0 in the Blackboard gradebook. And so if you do have unsubmitted assignments, those will pull your grade down. Right now, your grade is based on only the assignments that have been submitted. And so any missed assignments can still be turned in, but no later than the 19th. Questions, anybody, about where we go from here? And specifically for the people who come to class on campus, if you plan to come to campus on Tuesday because you have something you want to review, if you need to meet with me here in the classroom, just let me know. Otherwise, I'll be down in my office probably. I'll just connect Zoom there because if I don't hear from you, I'll assume everything's good and you don't plan to meet with me that day. So, all right. The first thing we're going to look at today then is the talk about the lead up to the exam. And I'm going to go into CNow for that. So as with every other exam we've had this semester, there is a practice set of exercises, and that's what I have up on the screen right now. So there are 10 practice exercises. These are completely optional. You are welcome to do them or not do them. I think they're beneficial to practice for the exam because they are very similar to work that you will see on the exam. But just like with all the other exams, I don't necessarily look to see who has worked on the practice exercises, but if you're working on them, I would be happy to help you with anything. Many, if not most of them have the show me how. Of course, all of them have the check my work button. And if those are not helpful, if you're stuck, you can always ask, even though these are not graded. I do think it's an important step to make sure you're prepared for the exam. So there are exercises from each of the chapters, 12, 13, and 14. If you do have someone in the class who you tend to work with, you are welcome to do that for any assignment other than the exams. I would just remind you that for these practice sets, as with the other chapters, they are algorithmically generated. So everyone has the same exact set of questions, but the numbers that appear in the exercises will be different on yours than on mine, than on anyone else's in the class. So some of the numbers may be the same, but definitely some of them are different. So if you are working with someone else, it is important to keep that in mind, that their numbers are going to look a little bit different than yours. Let me pull up the exam next. And so this exam has a total of 30 questions. It's a mix of multiple choice and exercises, again, just like you've seen on all of the other exams. Reminder, you need to open your textbook, your ebook, before you open the exam. If you forget to do that, stop immediately, send me an email so that I can help you with that, because you definitely should have access to your text for the test. That's the intent, is that it is open book. Same 3-hour time limit unless you have accommodations. Mix of exercises and that require possibly some calculations and multiple choice. And just as with the other exams, the multiple choice questions are generally worth fewer points than the exercises because they take less time. Most of the exercises do require some kind of calculation, where the multiple choice are most of the time, read the question, choose the correct answer. So total of 30 questions, same 3-hour time limit as always. Any questions, anything you want to ask about before we move on? I had an email this morning or last night, can't remember now, from a student who's in the asynchronous online class. And so I just want to make sure I repeat this, and I'll put it in the announcement today too, assuming I remember to do that. Make a note here. So just a reminder that if you are taking BUS 1520, Principles of Managerial Accounting, if you're taking that with me next semester, whether it's on campus, on Zoom, or online, the subscription that you purchased for this semester will continue to work for that class for next semester. So do not purchase anything new for next semester. It does not give you the entire Cengage Unlimited catalog like you had this semester, but it gives you what you need for my class for 1520. So in that class, we pick up in chapter 15. So in the structure of that class is very similar to what we're doing in this class. The assignments are mostly similar, with the 10 exercises, the chapter problem, the pre-quizzes. We have only 4 exams in that class rather than 5. And there's one project that's kind of a semester long, well, it's about a 10-week project that's assigned day 1 and is due around week 10. And rather than having the little mini projects throughout the semester. Other than that, the content is very different. Managerial accounting is very different than financial accounting, but the structure of the course will look very similar to what you're used to. Before we pick up with chapter 14, any questions, comments, anything you want to talk about? All right, if not, then let me go to our presentation to get us started. And so last class we did the first half of the chapter on financial statement analysis. The first 4 exercises, and one of those I had asked you to complete on your own. The first 4 exercises were related to horizontal and vertical analysis. So it was looking at the financial statement, whether it was the income statement or the balance sheet as a whole, and doing some comparisons either within the year or across a 2-year period. As I said on Tuesday, there are other ways of doing that horizontal analysis where we might include more than just 2 years worth of data. We call that typically a trend analysis or a time series analysis. But for our purposes, for this class, the only ones you're responsible for being able to create on your own are the horizontal and vertical analysis, just as we did for the income statement and the balance sheet on Tuesday. The last exercise we looked at, then we kind of switched gears, and that's where we're going to stay for the rest of this chapter, is looking at individual components of the balance sheet or the income statement, or comparing two different categories, doing what we call a ratio analysis. So most, if not all of the calculations that we will do today involve looking at two different components of a financial statement, two different numbers, and comparing them, their relative size, by dividing. We did that on Tuesday with the receivables analysis, where we calculated days sales uncollected or number of days sales in receivable, something like that. The terms mean the same thing. Receivable, and also known as the inverse of that is receivables turnover. So we looked at both of those calculations for analyzing how quickly are we collecting from our customers. And we recognize that that impacts our liquidity, because the longer we have to wait to get that cash back after we sell to our customers, the more float or working capital we need in order to continue to pay our bills and run our company while we wait for the payment from our customers. Any questions about what we did on Tuesday, the first half of the chapter? Okay. So where we're going to pick up in exercise 6 is looking at our inventory. So our inventory can be analyzed using, again, two related measures, and you can see those on the screen right now. First, we will calculate inventory turnover, and then we flip that to determine how many days sales. So inventory turnover, just like receivables turnover, is expressed as a number of times. What that means is the number of times per year we are turning our inventory, or on average selling through our inventory. Number of days sales in inventory tells us, again, it's a related measure to inventory turnover, and it tells us on average how many days does it take us to sell each item. There are going to be, of course, some items we sell more quickly and some items we sell more slowly. So if we were looking at a grocery store, the perishable items like produce and dairy are going to sell probably much more quickly than items such as, canned soup or boxed cereal. When we talk about the number of days sales in inventory, then it's an average number. Just as we said on Tuesday, we have to work with the information we have, and so it may not be a perfect estimate, but we only have available, if we're an external decision maker looking at a company's financial statements, we only have what they are required to provide to us. So let's go to the next slide here. So this is the calculation. I'll go back to that previous slide in a second. This is the calculation for inventory turnover. Cost of goods sold. I don't know why that says costs of goods sold. That's an odd way of writing that. I'm going to call that a typo. Cost of goods sold is a component of the income statement. So we're going to look at their income statement for the end of the year and determine how much they sold. And then the denominator is average inventory. So just like we said with average receivables, on Tuesday, we're going to look at their balance sheet we're going to take the beginning balance and ending balance in inventory, add those together, and then divide by 2. So it's a straight arithmetic average of their beginning and ending inventory. So we're comparing a value from the income statement to a value from the balance sheet. So why do we care about this? Well, for one thing, it also, just like the receivables turnover, it also impacts that financing period or cash gap, because the longer we sit on our inventory, the longer we go with, we've already paid our supplier for it, and now we're waiting to sell it to our customer. So there's a liquidity issue, but there are some other issues as well associated with inventory. We take the risk, the longer we sit on our inventory, the more risk we have that we can't ever sell it, that it goes out of style, that it spoils, that it is no longer in demand in the marketplace. You can see some other risks here as well. There is cost associated with having that inventory. We have a special term for that. It's such a concern for business. We have a special term, inventory carrying cost, that accounts for all of this stuff. The fact that we have to have a place to store it. We might need to be paying someone to move it around for us, the warehouse help, and so on. So the longer we are carrying our inventory, the more risk and or cost is associated with that. Now, this is very industry dependent. So when we talked about on Tuesday needing to have a standard of comparison, and we talked about 3, I added one to what was in the book. The one that I added was, sometimes we have just a rule of thumb of how frequently you should, in this case, how frequently you should be turning your inventory. We don't really have a rule of thumb for inventory turnover because it's very different. How quickly a grocery store turns their inventory, which is going to be every couple of weeks on average, is going to be very different than, say, a department store that is really going to be turning their inventory more seasonally, so 4, maybe 5 times a year for a department store like Kohl's or JCPenney. So there is no one rule of thumb for inventory turnover, but certainly if we go on to the other 2 standards of comparison that we discussed on Tuesday, certainly we can compare how are we doing this year compared to how did we do last year. And in general, we're looking to turn our inventory more quickly, a higher turnover is better. And higher turnover is generally better. As we discussed in the inventory chapter, though, it's better up to a point. If you're turning your inventory so quickly that you're experiencing shortages, you may be losing sales and ultimately losing customers. So there definitely is an art to inventory management. There's some science in there too, as we look at statistical data that telling us how much we should expect to sell. I like to use the example in the spring semester that as you lead up to Easter, stores need to know they need extra eggs in stock because families are buying eggs to color them, and of course the Easter bunnies, they're buying eggs as well. Pretty sure he buys those at the grocery store. So there's definitely an art and a science behind that inventory carrying question. How much should we have? How much do we order? Do we set order points when we get to a minimum and so on? So the inventory turnover calculation, we're going to look at exercise 6 in just a moment. You may want to make a note of this calculation because we'll be using this in our exercise. And then, ignore that second calculation. I shouldn't even put that up. I should have hidden that slide because as I told you about receivables turnover and days sales uncollected on Tuesday, I think the book makes it unnecessarily complicated. And so I'm just going to give you a much easier way of looking at it. So let's start with inventory turnover. This is exercise 6 in chapter 14. The following data were extracted from the income statement of Heaver Incorporated. And we have our data from the current year and the previous year, as is always, or virtually always the case. You'll notice the current year data are to the left. They are closer to the descriptions because those are seen as the more pressing and more important information when we're analyzing our company. So let's look at the current year's inventory turnover. If you made a note of that calculation, you know that the calculation is cost of goods sold divided by average inventory. Well, we need to find our average inventory. We know the ending balance for the current year. The ending balance from the previous year would be the beginning balance for the current year. So let's go ahead and calculate our average inventory for the current year. Whoops. So 1,120,000 plus 940,000. Make sure you do that calculation, the addition part, before you divide by 2. If you just punch it into your calculator without the brackets or the grouping symbols, your calculator will probably follow order of operations and it'll do the division before it does the addition. If you get an average that's not between the two numbers you're averaging, you know you've done something wrong. That's what I call the reasonableness check. Does that number even make sense? So there's our average inventory for the current year, $1,030,000. Now we can calculate our inventory turnover by dividing our cost of goods sold, $9,270,000, by the average inventory. Round interim calculation. Yeah.
I'm sorry, my daughter was talking to me and I missed how you got that average inventory number.
Sure, no problem, Jamie. So the average inventory is the beginning. There's the beginning inventory plus the ending inventory. Addition is commutative, so it doesn't matter in which order you add those. But add those two together, get a total, and then divide by 2.
Okay, thank you.
Okay. Any questions about the inventory turnover for the current year? So this company, Heaver, by the way, is doing a comparison from one year to the next. That third standard of comparison that I mentioned but that have not yet reminded you what it was, mentioned there are 3. We have the rule of thumb, comparing ourselves to ourselves. That's what's happening here. But the third standard of comparison is comparing ourselves to some other competition, one single competitor in a process we call benchmarking, or maybe comparing to an industry average. So Heaver is turning, in the current year, turned their inventory 9 times. On average, they sold through their inventory 9 times in total during the year. I told you I would give you a calculation that I think makes a lot more sense than the way the book does it. They unnecessarily complicate it. Once you have that inventory turnover, you can convert that into number of days sales in inventory by simply dividing that number into 365 days. So 365 days divided by 9 times, they turn their inventory 9 times during the year, and we're asked to round to 1 decimal place, so it would be 40.6 days. They're selling through their inventory in the current year. They sold through their inventory about 40.6 days. Or another way of thinking about that is they had the average piece of inventory they held for 40.6 days before they sold it. Or another way of looking at it is if they didn't buy anything starting today, in 40.6 days, they would have sold through their inventory. Again, we know that's not true for every inventory. Some items sell faster, some items sell more slowly, and that's fine. We're talking about on average or in general. Any questions about how we calculated those two numbers? Okay, so go ahead, please, and do the previous year calculation on your own.
I have a question. So for the current year, you got 9. That was the inventory for the current year, but
Inventory
that-
current, yeah,
do we use the same days for the previous year? Same number?
the same 365 days, is that what you mean?
No, so the 9 days out of that 4, do we,
That 9 days for inventory turnover?
yeah, so for the previous year, I don't see
Yes.
where,
I'm not sure if this is what you're asking, but we need to find the average inventory for the previous year. Is that what you're asking about?
yeah, so do we use the 9 days still?
Is this the 9 you're talking about, Jamie? The one I just
Yeah, but
highlighted? Yeah, so that's
Yeah.
9 times, and no, that's the calculation for the current year. We just need to do our calculation for the previous year. So we start with finding the average inventory for the previous year, which is going to be the average of the beginning inventory here
Mm,
and the ending inventory here. That's the first step.
okay, beginning and out. Okay, so we add those two together.
Yeah.
And then we divide by 2
Yes,
to figure out the inventory turnover.
that number, right, the calculation I just put on the screen up here at the top, that's
Uh-huh.
just the average inventory. And that's going to be, if I were to go back here. There we go. So there's our calculation, cost of goods sold divided by average inventory. So we needed this average inventory number before we can calculate inventory turnover.
Okay, thank you.
Yep, you're welcome. So average of 860,000 plus 940,000. And then divide that into our cost of goods sold. And then to find the number of days sales in inventory, just divide the inventory turnover into 365, round 1 decimal place. Everybody good with those? Oh, geez. The number of times that you, on average, you sell through your inventory in a year. So for the previous year, they sold through their inventory 12 times. That's like once a month, right? So, and that's where this 30.4 comes from. So it's taking them a couple different ways of interpreting it or thinking about it. It's taking them about 30 days to sell their inventory, or they have about 30 days worth of inventory on hand at on average at any point, or any given piece of inventory takes about 30 days to sell. The significance of this, just like with the receivables turnover, is that it has an impact on our liquidity, because we bought that inventory and then we're sitting on it for a month on average before we sell it. So that's a month after we buy it before we even sell it to our customers. If we sell it on credit, then we have to wait for the customer to pay us
every single
we
time, other than
Jamie, I'm just, oh, I'm not sure who that was.
Not-
Okay, I'm just gonna review. And so it has an impact on our liquidity. It has an impact on our cash flows. The longer we have to wait before we sell our inventory, the more financial backing, flow, working capital, whatever you want to call it, the more cash we need to have available so that we can keep doing business and paying our employees and paying our suppliers before we can replace that inventory, before we get the money back from our customers. So the number of days sales in inventory and the number of days sales in receivables or days sales uncollected that we looked at last class. And there's one other measure that counts here for the inventory turnover, for the financing period and the operating cycle. The other number that's important to us is how long does it take us to pay our suppliers? I don't think I feel up to, I can try. I'm going to try to put a quick drawing up here on the screen. We'll see if I can make this make sense. Whoops. Okay. So two calculations that we just looked at. From the time we buy the inventory, so I'm going to label this buy. So from the time we buy the inventory until we sell the inventory is what we just calculated, that number of days sales in inventory. So for our example here, for the previous year, we could say that was 30.4. From the time we sell the inventory, if we sell it on credit, until we collect, is a second calculation, which we did last class. Days sales uncollected. How long on average is it taking us to collect from our customers? Let's say we're taking, I don't know, I'm just going to make up a number. Let's say we're taking 15.2 days on average to collect from our customer. I just made that number up. So from the time we buy the inventory until we collect from our customers, that calculation is known as the operating cycle. So for this company that I'm making up here, the operating cycle would be 45.6 days. From the time they start the process of buying the inventory from their supplier, selling it to their customer, collecting from their customer, that's called the operating cycle. The other piece here from underneath is from the time we buy until we pay our supplier. Whoops, supplier. So from the time we buy the inventory until we pay our suppliers is another calculation. And I don't think we have an example of that calculation in our exercises. I think we do. But it's a very similar calculation to what we've just done with receivables and turnover. And it is called the payables turnover. And it's a calculation of how quickly we pay our suppliers. It's very similar to this calculation of how quickly our customers pay us. Let's say, I don't know, let's say we pay our suppliers every 10 days, or on average, it takes us 10 days to pay our supplier. So the operating cycle we already said is about 45.6 days in my example. But the fact that we can have a bit of a delay before we pay our suppliers shortens up how long we're out the cash. And so from this, whoops, let me get a number right here. From this point to this point is called the financing period. From the time we spend the cash to our supplier until we get it back from our customer is called the financing period. So this whole thing, let me change colors here. From here to here, that whole thing is called the operating cycle. But from here to here is called the financing period or the cash gap, more casually. So 3 different calculations go into that, 2 of which we just did. Number of days sales in inventory, how long from when we buy the product till we sell it. Number of days sales uncollected, how long from when we sell the product to our customers until they pay us. And then this one down here, how long until from the time we buy the inventory until we pay our supplier. A company that's super good at cash management, and a good example of this, at least historically, has been Dell Computers. Dell had a really, and I'm just not sure if it's 100% true anymore, but they had a really good relationship with their suppliers. In fact, in order to be a supplier for Dell, you had to be located within a certain radius of their production facilities. There's something like 100 miles or something. And the reason was so that they could place an order and get it to them quickly because they were geographically close. And so Dell, again, used to do kind of custom order computers. And so you would go on and indicate all the stuff that you wanted in the computer and they'd make it and sell it to you. Perfect example of what in manufacturing we refer to as pull-through production. You made the computer because someone ordered it. Dell had such a great relationship with their suppliers. They had such a good hold on their supply chain that they would take an order from a customer, sell the computer, build it, sell the computer to the customer, collect from the customer, and then pay their supplier. Yeah, it was a great deal. They had a negative financing period, at least 10 years ago. I don't know if that's still true. I haven't looked, but that's a kind of cash management that is really beneficial for a company when you can do that, because they didn't have to worry about did they have the cash available to pay their suppliers, because they got the cash from the customer before they had to pay their supplier. Good deal. Interesting case there. Let's answer our questions here so we can keep moving. The inventory position of the business. So has it gotten better or worse? They were selling their inventory about every 30 days. Now it's every 40 days. Is that better? No. So it has deteriorated. The inventory turnover decreased while the number of days sales in inventory has increased. They're just asking for the relationship from previous to current year. Now, as we discussed last class, and as we just saw, if you think about how we did those calculations, it will always be true that if one of those values increased, the other one decreased. They're inversely related. We literally calculated number of days sales inventory by putting the inventory turnover in the denominator of the calculation. Another reason I don't like the way the book teaches it. Not only do they unnecessarily complicate it, they also make it a little harder to see that relationship. So what has happened to their sales volume? Last year they sold 20 million. This year they sold only 18.5 million. So their sales volume declined faster than inventory. Even while their sales went down, their inventory was creeping up. Again, there may be a relationship there. It may be that they kept ordering the same amount of stuff and they just weren't selling it. That happens. That's what's called a leading indicator for the economy, is when the inventories start building up. Because there's a recognition lag where companies continue to make the product or continue to purchase the same amount of product while they until they recognize, oh, wait, our sales are going down. We don't need so much stuff. So a buildup of inventories is actually a leading indicator. It's one of the early signs that the economy is not, is declining, is taking a turn. So resulting in a deteriorating inventory position. Any questions on that exercise? All right, we'll keep going then. I need to scroll ahead here. Oops, wrong one. That's the one I want. Our next exercise, exercise 7, is, although it doesn't say it in the title of the exercise, the calculations we're going to do in this next exercise are solvency calculations. So we said on Tuesday, we were going to be looking at 3 specific areas: liquidity, profitability, and solvency. I pointed out that there were a couple other areas that you might see in a full financial statement analysis. They included cash flow adequacy and market strength. So we're not doing those in this chapter, but those are definitely a big part of a analysis of a company. So solvency analysis evaluates a company's ability to pay its long-term debts, where liquidity, remember, was a measure of how likely it is that we can pay our current liabilities. So we did things like current ratio, quick ratio, working capital, and we looked at those back in chapter 5, I believe, 4 or 5. So the solvency ratios that we're going to be looking at in exercise 7 are what you see here on the screen: the ratio of fixed assets to long-term liabilities and the ratio of liabilities to stockholders' equity. So you may want to make a note of these calculations, although if you just read the title of the calculation we're doing, it really tells you what you're doing. Ratio of fixed assets to long-term liabilities. There's the calculation: fixed assets divided by long-term liabilities. Assets and liabilities, of course, are 2 components of the balance sheet. So unlike what we did in the last 2 exercises where we were comparing something from the income statement to the balance sheet, now this is just a straight balance sheet calculation. These are long-term calculations or long-term solvency measures. Here's the other ratio that we're going to be doing in our exercise 7. And again, the title of the ratio really tells you this is what you're doing. It's liabilities from the balance sheet. In this case, it's total liabilities to total stockholders' equity. So let's go to our exercise now that you have those formulas. Recent balance sheet information for 2 companies in the food industry, Mondelez International and the Hershey Company, is as follows. So now we are doing a comparison from one company to the other, that third type of comparison that we discussed. We'll start with Mondelez. And I think this is an interesting exercise. I really like this one because I think everybody in this class has probably heard of the Hershey Company. If you live close to campus here, we live fairly close to Hershey, Pennsylvania, and Hershey Park. And you go in the grocery store, and of course, you're seeing Hershey chocolate bars. So everybody knows the term Hershey, or knows the company Hershey, but probably most of you, if not all of you, have never heard of Mondelez International. But when you look at their dollars, Mondelez is about 4 times the size of Hershey, even though Hershey's the one that's familiar to you. So we start with the ratio of liabilities to stockholders' equity for each company. So let's do Mondelez first. So it's total liabilities. We have current liabilities, long-term debt, and other long-term liabilities. All 3 of those combined will give us our total liabilities. So for Mondelez, their total liabilities I got $36,323,000 when I added those together. And we're going to divide that by their stockholders' equity, $25,215,000. And we're asked to round to 1 decimal place. This is a measure of the company's leverage. It's looking at the credit side, the right-hand side of their balance sheet, and comparing what do they have in liabilities, what do they have in equity. The more liabilities a company has compared to their equity, the riskier they are, the more leveraged they are. There are advantages and disadvantages to companies that are leveraged. And so whether you would, if you were looking at an investment, whether you would prefer a highly leveraged company, and the higher this number is, the more leveraged they are. So if, as you're looking at this number, a higher number means more leverage. More leverage equals more risk because liabilities have to be repaid where equity does not. I can't look at this number 1.4 and say, is Mondelez highly leveraged? Because as we said on Tuesday, well, compared to what? Highly leveraged compared to what? And so we're going to do the same calculation now for Hershey. If you haven't already done that, go ahead and do the calculation on your own for Hershey. Add their all three pieces that make up their liabilities. And then divide by their total stockholders' equity. And round to 1 decimal place. And now we can do that comparison. Is Mondelez highly leveraged? Well, not compared to Hershey. Hershey has a whole lot more liabilities as compared to their stockholders' equity. Hershey has a lot more liabilities than Mondelez. Any questions on that? Okay. So for our next part, part B, determine the ratio of fixed assets. So that's going to be our net property, plant, and equipment. We are familiar with, at this point, that term net means, well, they've subtracted something from the total, and what they have subtracted from the total is the accumulated depreciation. So the net property, plant, and equipment is their fixed assets. And then the denominator, the bottom part of that calculation, is the long-term liabilities. And that is these two categories, long-term debt and other long-term liabilities, which could include things like pension liability and things like that. So the denominator is going to be the combination of those two long-term debt categories. And the numerator is going to be the fixed assets, the net property, plant, and equipment. And we're asked to round to 1 decimal place. So I added together the 13,217,000 plus 8,689,000. Added those together. That's the denominator, and I divided that into the 8,229,000. I got a ratio of 0.4 when we round it off. Again, I can't say whether that's good, bad, or anything else, because I need to compare it to something. And so we're going to compare it to Hershey. If you have not already done the Hershey calculation, please go ahead and do that. Add together the two long-term liabilities and divide it into the net property, plant, and equipment. And round to 1 decimal place. So now what do we do with these numbers? What does this tell us? We already mentioned what part A tells us, which is Hershey has a whole bunch of debt. Relatively, size-wise, dollar amount, their debt is way lower. But because they're a quarter the size of Mondelez, as a percent, Hershey has a lot of debt. So Hershey uses more debt. However, what we see here with part B is that they have a better, a stronger ratio of fixed assets to long-term liabilities. again, the higher number there is better. It means more protection. They have more assets available compared to their liabilities than does Mondelez. So it has better, slightly stronger creditor protection and borrowing capacity. And all these are relatives, remember they're ratios. So we're not talking about absolute dollars, we're talking about ratios, or the relationship between the different categories, total assets and, total liabilities, total stockholders' equity, looking at the relationship between the two, or total fixed assets to long-term liabilities. Questions on that? So I really like this chapter as the final chapter for our entire class, because as we've spent 13 chapters learning how to produce the financial statements, as I said on Tuesday, many of you will not be involved in actual production of financial statements, but most of you at some point in your career, and maybe frequently in your career, will be asked to look at a set of financial statements and understand what's on them, understand what it means. Even if you're not preparing them, you need to know how to use them. And so I like this chapter as the wrap-up chapter, because it helps you to see how all that stuff we've been doing can be used by an actual individual to analyze a company. Moving on then to exercise 8. And I need to go back to my PowerPoint just for a moment here and talk about what we'll be seeing in exercise 8. So exercise 8 is the profitability analysis. So we've looked at liquidity, we've talked about liquidity and solvency, and now we're looking at profitability. In exercise 8, we're going to be looking at 3 different calculations: return on total assets, return on stockholders' equity, and return on common stockholders' equity for a company that would have also preferred stock. If the company does not have common and preferred stock, there would be no difference between those 2 calculations. So we mentioned on Tuesday that the reason there's a difference between liquidity and profitability, at least part of the reason, is because we use accrual accounting. And so what shows up on our income statement, as we spent all of chapter 13 discussing, what shows up on our income statement is not necessarily indicative of how much cash we have. So the liquidity question of can we pay our short-term bills is based on cash, but the profitability is looking at what's on our income statement. Profitability then speaks to, is this company viable for the long term? Not only do we have to be able to pay our bills in the short term, we need to be making money at what we do to run our business. So you can see on this list, some of the profitability ratios. We'll be looking at 3 of them that I just mentioned, the middle 3 here. No, sorry, 2 of the middle 3 plus return on total assets in exercise 8. And then in exercise 9, we'll be pulling together the rest of these with some we've already done. And to wrap up our day in exercise 10, we'll be looking at some stock-related calculations that you see here in the far right column. Price to earnings ratio, or PE ratio, dividends per share, and dividend yield, which I had actually mentioned in class last time. The idea that some investors may not want dividends at all, but dividend yield is a market-related, dividend yield is one of those market-related calculations, market strength, because it involves the market value of the stock. The same thing is true for the PE ratio. So we're going to be going to exercise 8 in just a moment to do some calculations. I'm just debating whether I want to have you copy down all of the formulas now because they're not in order. Maybe it would be easier if I just gave you the formulas in order as we work on the exercises rather than trying to jump around in the PowerPoint. I did some rearranging in the PowerPoint, but I did not put those sections in order. So let's just take this one at a time and I will give you the formula as we look at each calculation rather than trying to jump around in the PowerPoint. So we have some data for Vita Hill Incorporated. You can see the data are for 3 years. And we'll be doing the calculations just for the 2 years, but in some cases, we're going to need that third year because we need the beginning balances for 2016. In case you're wondering why they gave us 3 years worth of data when we're doing 2 years of calculation. These would represent our beginning balances for 2016. We're given some additional information underneath the table that we will need as we go through this. And we're going to start with return on assets. I think we'll do the 2017 calculations together, and then I'll ask you to do the 2016 on your own. So we're going to start with return on total assets, and I'm going to put the formula on the screen here. I'll do these one at a time. So return on total assets is, I'm just going to put the formula underneath because I don't have a whole lot of white space on the screen. So the numerator, the top part of the formula, is net income plus interest expense. Whoops. So the top part of the formula, the numerator is net income plus interest expense, and the denominator is average total assets. So just like all of the averages that we've been looking at, we are going to be taking the beginning and ending balance, adding them together, dividing by 2. So for 2017, let me find our average total assets. Well, we had 4,800,000 at the beginning, or excuse me, at the end of the year. But we had 4,400,000 at the beginning of the year. I know that because, oops, get that out of the way. I know that because it was the ending balance from 2016. So I'm going to add those together and then divide by 2 to find the average. So for 2017, our average total assets was 4,600,000. Beginning plus ending divided by 2. That's going to be the denominator of our calculation. The numerator is net income. And right here, we're told the net income was 372,000. And apparently we get to calculate the interest. So it doesn't tell us the interest expense, but we can calculate it. What were they paying interest on? These notes payable, and it was 8% interest. So the interest was 8% times those notes payable. And actually they've made it a little easier for us because it's the same notes payable each year, each of the 2 years. So 8%, the notes payable didn't change. Those are clearly long-term notes payable. We were paying $180,000 in interest each year. So back to our formula, return on total assets is the net income. For 2007, that was $372,000. Plus the interest expense of $180,000. And then we divide that number by the average total assets, 4,600,000. Return on total assets, like all three of these calculations, is expressed as a percent. So as a reminder, to make a decimal into a percent, you need to move the decimal place 2 places to the right. At the same time, you add the percent sign. Any questions on return on total assets? As long as we have that formula on the screen, go ahead and do the calculation for 2006 on your own. Remember, we said on Tuesday that a complete analysis doesn't look at just one calculation. It doesn't even look at one area of calculations. You don't do a liquidity analysis without paying any attention to profitability and solvency, cash flow adequacy, market strength, all of those. So based on this one number though, return on total assets, we would say that they were doing better last year than this year because a higher number is better. Everybody okay with that calculation, return on total assets? So let's move on to our return on stockholders' equity. And again, I will give you the formula here on the screen. Return on stockholders' equity is net income divided by average total. I'm abbreviating just to fit it in better. Net income from the income statement for the year divided by average total stockholders' equity, which is beginning plus ending divided by 2. So again, we'll do the average stockholders' equity for 2017 here on the screen. So what do we know for stockholders' equity? We have the common stock, we have the preferred stock, and we have retained earnings. All of those are components of stockholders' equity. So we're going to add those 3 parts for 2017, those 3 parts for 2016, and average them together, divide by 2. And I got $2,148,000. I added, whoops. I added these 2 numbers, these 2 numbers, these 2 numbers. So I added all those 6 numbers together and divided by 2 because we're looking for the average total stockholders' equity. Now we find our net income for the year, $372,000, and divide by that average stockholders' equity. And then change it into a percent and round to 1 decimal place on that percent. Yeah, so I added, so these 3 things, common stock, preferred stock, and retained earnings all make up the equity. So I had to add those from 2017, all 3 numbers to get the total for 2017. And then I added these 3 numbers for 2016 to get the total for 16. Add those together and then divide by 2. So if you got that, go ahead and try the 2016 number on your own. I got 20.
What I was just gonna ask, are we gonna have, is there gonna be somewhere where we're gonna have like a formula sheet for the test? So I noticed, I didn't really see any of these resources. So I kind of have to go through the book or just make one up on my own for it.
Yeah, I don't have a formula sheet. I might be able to put one together. Okay.
That's what I usually end up doing, but if we had so many of these formulas, I don't know.
I'm trying to think if there's one in the book, like an actual page, and I'll need to, I'm gonna make myself a note and I'll check that after class, because there may be a page in the textbook, like in the textbook I used before I switched to this one this year. The page in the text, there was like the front inside cover of the textbook was all the formulas that you'd use for the whole book, for the financial analysis stuff. I have an actual Word document that goes along with that old book. The terminology is a little different in this book, but I can probably make sure that it's updated. Let me see if I can find a formula sheet or create a formula sheet and post that, and I'll of course put an announcement out that it's out there. So
I would appreciate that.
that's a good idea.
I mean, that's what JP had said is what I've done for like all the rest of them, but
Yeah.
it seems like we have so many different, I mean, we're using 3 different formulas on this one alone.
Right. Yep.
We've used a whole bunch of other questions, so I know for me, if I had to make one ahead of time, I could probably do it real quick. but-
Yeah. Yeah, it would be helpful to have one. I agree. So let me see. And it's something I hadn't even thought about, but it is something that I have always had until this textbook. I just hadn't thought about it. So I made a note and I will look as soon as I get a chance, which should be later this morning.
Appreciate it.
So any questions on return on stockholders' equity? I don't know how much you guys on Zoom can hear the conversation in the classroom, but I'm going to be pulling together or locating for you a formula sheet that would just list all of these formulas. The calculation part shouldn't be terribly complicated when you have the formula. The important part is that you know what the numbers mean, so that you can look at it and say, you know, is it a higher number that's better? Is it a lower number that's better? And it depends on what the calculation is, whether you're looking for a higher or lower number. For this exercise, return on stockholders' equity for these 2 years, a higher number is better. A higher number is better. And so just like with return on total assets, we would look at this and say, yeah, they were doing better last year than this year. For the last one for this exercise then, return on common stockholders' equity. I'm going to put the formula on the screen as I have been doing. So return on common stockholders' equity is, the numerator is net income, but we're going to subtract from that the preferred dividends, because that's earnings that are not available to the common stockholders. They went to the preferred stockholders. So we'll have to figure that out for this exercise. And then the denominator is average common stockholders' equity. And so for this calculation, we're going to be Excluding, it's basically the same calculation, but from the numerator, we subtract out the preferred dividends, and from the denominator, we subtract out the book value of the preferred stock. So I'll start with our 2017 average common stockholders' equity. Whoops. And we're going to be adding together just the common stock and the retained earnings. We're going to be removing the preferred stock from that. If I had the number still up on the screen, I could have just subtracted $500,000 from it to get the preferred stock out, but I already erased it, so I've got to redo that calculation. Add together the common stock for the common stock and the retained earnings for the 2 years, and then divide by 2 to find the average common stockholders' equity. Now keep in mind, this is the book value of the common stock. It is not the market value, it's the book value. The numerator then is net income minus preferred dividends. Well, we need to figure out how much the preferred dividends are. It tells us that preferred dividends were declared and paid in full for both years. So this is good review from chapter 12. What is our preferred dividend? The preferred dividend is the par value times the stated dividend rate, 4%. And that would be $20,000 per year. The preferred dividend is $20,000 per year. It's 4% of the par value. Par value is $100 per share. That's $4 dividend per share per year, if it's paid in full. As you're reviewing for the exam, I'll just throw out there, remember the difference between cumulative and non-cumulative, that it does tell us they paid the dividend in full for each year. Now we can do our calculation. We have what we need. For the numerator, it's going to be net income for 2017, $372,000, minus the $20,000 preferred dividend. That means of that income, $352,000 was available for the common stockholders. I'm not saying they paid it out. In fact, it tells us they didn't pay any dividends, that those were earnings that remained in the company and increased the value of the preferred stock, excuse me, of the common stock. Then we divide by the average stockholders' equity, which we already figured was $1,648,000. Change it into a percent and round to 1 decimal place. It's 21.35, so we're going to round that up to 21.4. Again, we need something to compare that to. Is 21.4 good? I have no idea. Good compared to what? And so we're going to do the same calculation for 2016. Find the average stockholders' equity, common stockholders' equity, by excluding the preferred stock. And change it into a percent and round to 1 decimal place. So I got 38.18 or 38.2. And just like with the other two calculations, higher is better. Higher return is better for the stockholders. So we can then answer our questions. The profitability ratios indicate that the company's profitability has deteriorated, because the return on common stockholders' equity exceeds the return on total assets in both years, because the return on common stockholders' equity exceeds the return on total assets, there is positive leverage from the use of debt. So let me just explain what that means. I kind of started talking about it. Leverage refers to the use of debt within the capital structure of the company. Debt is risky. It has to be repaid. However, it's repaid at a set rate, whatever the interest rate, whatever the cost of that borrowing is. And so when a company is highly leveraged, let me just give you a quick example. Let's say we borrowed at 5%. Okay, we borrow at 5%. That's our cost of borrowing. And we do some project. We take on a new product line. And the product line returns 3% on the project. Guess what? We still have to pay back the loans at 5%. So the stockholders end up losing because basically that extra 2% comes out of their earnings, right? We still have to pay back the project at the borrowing at 5%. I'm very much simplifying this. Let's say the project returns 5%. Guess what? The 5% pays off the cost of borrowing, and there's no advantage or disadvantage to the stockholders. But what else could happen? The project could return 6, 7, 8, 10, 20, 50, 100%. Everything past the 5% goes to the stockholders because we still only have to pay back the borrowing at 5%. That's the advantage of leverage, is it keeps the profits in the hands of the stockholders because we're borrowing it at that fixed 5% rate in my example. And that's why this last question here indicates there's positive leverage from the use of debt. Because while let's take the most recent year example, while our total assets returned only 12%, the return for the common stockholders was 21.4% because they were using debt, and maybe they only had to pay 6% on their debt, 6% interest rate. The other 6% goes to the common stockholders. It is riskier, but it does increase the possibility of higher returns. Any questions before we move on to the next exercise? Make sure we get through these before we run out of time. Questions, anybody? Let me erase my pictures here and go on to exercise 9, 6 measures of solvency or profitability. Now, I am going to skip. Actually, I'm looking at this. I'm going to skip most of these for now because we have about 18 minutes left in class. All of these we have already done with the exception of asset turnover. And so I'm going to skip to asset turnover for now. And we'll do asset turnover, and then we will go to exercise 10, and if time permits, we'll come back and I'll just have you work on these on your own at the end of class. But asset turnover is one that we have not yet done, and so I would like to do that one together, and I'll give you the formula for that here on the screen. Okay. Asset turnover, you frequently see abbreviated as AT, asset turnover. And the calculation is sales from the income statement, of course, divided by average total assets, excluding, I'm going to write this into the formula, excluding long-term investments. So the numerator is sales from the income statement. The denominator is average total assets, so beginning plus ending divided by 2, but we want to take out any long-term investments. See if we have any. I don't know if we have any in this exercise. I need to scroll back up here. So what do we have? Whoops. Might have to figure out our total assets. Okay. Okay, we can do that. I don't see where we're given that figure, so let's find our average total assets. Let me remind you of the fundamental accounting equation, assets equals liabilities plus equity. You have now known this formula for, abbreviate, you've known this formula for 14 weeks. Assets equals liabilities plus stockholders' equity. I don't, unless I'm missing something, they're not giving us the total assets anywhere, so we need to find that. Am I missing it?
Total assets is at the bottom.
Oh, thank you. We could have figured it out because they did give us the liabilities and equity, but that will be much simpler. That's why it pays to read everything on the screen. Thank you for being diligent. So total assets were 7 million at the beginning of the fiscal year. We're still going to have to find the, we're still going to have to find the assets from the end of the year because we can't assume that they didn't change. It's much more likely that they did change. So that will be helpful to find the average, but it's not going to help us with the ending balance. So let's do that. I'll keep going with what I was doing here, but thank you for finding that because that will help us in a minute. So our liabilities plus equity. Our total liabilities were 3 million. That's given right here. Our total equity was 5 million. And that's given right here. And so our total assets must have been $8 million at the end of the year. Okay, we're getting closer. Remember, we're going to exclude our long-term investments, and we're told right here that our long-term investments were 3 million. So total assets excluding long-term investments at the beginning of the year, 7 million minus 3 million. That would be 4 million at the beginning of the year. At the end of the year, it was 8 million minus the 3 million, or 5 million. I'm going to put one more line in here where I can squeeze it in. So our average total assets, excluding those long-term investments, would be the average of 4 million at the beginning of the year, 5 million at the end of the year. That's $4.5 million. Everybody with me so far? Anyone with a question on that? Andrew, you look like you're looking at the screen like, where did that come from? Am I misreading your expression?
Cindy,
Somehow
can
I
you-
got 4.4 for the average. Because I got 4 million at the beginning of the year, and then 4.8 at the end. 8 million minus the 3.2. But it was coming up that I got it wrong anyway. So.
Yeah, because it tells us here long-term investments for 3 million throughout the year. So I'm not sure why you subtracted 3.2. Oh, it looks like you subtracted the property, plant, equipment. Yeah, those are not long-term investments. That's the fixed asset. Sharon, were you going to ask something?
Can you please repeat how you got the average total assets is equal to 4.5?
Yes. Yep. So at the beginning of the year, remember we have to exclude those long-term investments. So from what you and JP noticed for me at the bottom here, total assets at the beginning of the year were 7 million. But of that 7 million, 3 million was the long-term that we needed to exclude. So 7 minus 3 is 4 million at the beginning of the year. All right. And then at the end of the year, we did this calculation to find that the total assets were 8 million. They've gone up by 1 million during the year, but still 3 million of those were the long-term investments that we needed to exclude. And so that would be a 5 million at the end of the year, 4 million at the beginning of the year. The average of those two is the 4.5 million.
Okay, got it. Thank you.
And Drew, you're good with that now too?
Yeah.
So now we can finish our calculation. Asset turnover is sales, which are given right here. 18, whoops, not that second line. $18,900,000 divided by our average total assets excluding long-term investments, which we just went through, is 4.5 million. And so the asset turnover is 4.2. 4.2. For every dollar we have in assets, that's helping us to generate revenue. So the reason we exclude those long-term investments is by definition, those investments are not being used in the day-to-day operations. So of the assets we are using in the day-to-day operations, we're generating about $4.20 in sales for every dollar in productive assets. That's how we would read that asset turnover. It's expressed as the number of times, 4.2 times. We're generating $4.20 worth of sales for every dollar in productive assets, assets that are being used in the running of the business. So for the ending balance, that was 8 million minus the 3 million for, so 5 million in productive assets at the end of the year. But it was 4 million at the beginning of the year, because it was the 7 million total minus the 3 million that are not being productive because they're just investments. Does that make sense? And so we had 4 million at the beginning, 5 million at the end, we averaged them together. Any other questions on that? As I said, I'm going to stop there for this exercise because all of the other 5 we have already done, so they'll be reviewed for you. There's not a show me how here, but there, because we're going to run out of time. There's not a show me how, but there is a check my work, and of course you can always ask if you get stuck on something, because I'm going to ask you to do those on your own outside of class, because we're going to be out of time. And let's move on then to our final exercise for the semester that we're doing together. And these calculations are related to the stock. And so I was referring to these as market strength ratios. So we'll start with earnings per share, or EPS. Earnings per share is a very common measure that if you're a stockholder, you're interested in how much money did the company make for me. Yeah, it's nice to know, to look at the income statement and see the total money they made, but how many stockholders do they have that are sharing in that as far as our earnings. Now, companies do disclose their earnings per share at the bottom of, usually at the bottom of their income statement, on the corporate income statement. So you'll likely see that when you look at your company. It's not something we would normally have to find on our own. Let's start with earnings per share though. Let me get my tool up here so I can write. So for earnings per share, we start with how much money did they make, net income. But this is earnings per common share. Remember, the earnings for the preferred stockholders are their dividends, right? So, and then the common stockholders get whatever's left. So we're going to subtract from that net income. Let me write this out better. Earnings per share is net income, but we're going to subtract from that our preferred dividends. Put this in parentheses here, because then we want to divide that by the number of shares of outstanding common stock. So these earnings are really being shared, and by that I do not mean to imply that they're being paid out or that they're being paid out as dividends, but it's how much the company made for the common stockholders. So we're only dividing it among the common stock that's outstanding. So remember from chapter 12, we have authorized, issued, and outstanding. We're only going to be sharing these earnings among the outstanding shares. Okay, so we start with our net income was $1,750,000. We want to subtract from that the preferred dividends. So what do we know about our preferred stock? Rather than being given a percentage as we normally are, we're given that it's $4. That $4 is the dividend. Okay, normally, we're used to it being, we are used to it being given to us as a percentage, but instead it's a dollar amount per share. And we need to figure out how many shares there are. It does not tell us how many shares there are, but it's $40 par value and $2.5 million. $2,500,000 divided by $40 per share would be a total of 62,500 shares of preferred stock. And it's $4 per share. The total of $250,000 in preferred dividends. I'm going to say that one more time. The preferred dividend is $4 per share. They had to, and there are 62,500 shares. So that's $250,000 that were paid out as preferred dividends. We're not told how many common shares there are either, but we can figure that out, how many common shares are outstanding, because it's a $20 par value and we have $10 million in that common stock account. So $10 million divided by $20 per share is a total of 500,000 shares outstanding. So there was $1.5 million in earnings shared among 500,000 common shares, and that would be $3 per share. Again, normally, by requirement, the company is going to be sharing that earnings per share number with you. It's not something you would normally need to calculate on your own, but now you know where it comes from. $3 per share. Any questions on that? The PE ratio, or price to earnings ratio, is just as it sounds. We're comparing the market price, and we're told that the market price of the common stock is $45 per share. So it's price to earnings, divided by the earnings per share that we just calculated. The PE ratio is 15. That one was simple. A little easier for us once we knew that earnings per share to calculate the PE ratio. It is exactly as the name implies, price, which is the market price, divided by the earnings per share. A lower PE ratio is referred to as a value stock. A higher PE ratio is referred to as a growth stock. The separating between them is usually exactly where we are with this company, 15 times earnings. You would say that the company is trading at 15 times earnings, a PE ratio of 15. at that rate, it would take you 15 years for the company to earn back for you what you paid for that share of stock. So we can't really do a lot of analysis with these because, as we've said many times, we have to compare that to something. So we can say whether the company appears to be growing or not by comparing the PE ratio from last year to this year, but we don't have that. Let's find our dividends per share. And let's see, our dividends were $1,125,000. So it's the total dividends divided by the number of common shares that we already calculated. We're told right here the dividends were 1,125,000. We already calculated there were 500,000 shares outstanding. And that is $2.25 per share. That's a super high dividend, not very likely if the company only made $3 per share, that they only basically kept 75 cents of that for retained earnings and paid out most of it. That would be very unusual. But it is what we're given. And as we're running out of time here, the very last calculation is the dividends yield. And it is, so dividends yield, this is what I had mentioned on Tuesday. It's dividends per share for the common shares that we just calculated as $2.25, excuse me, divided by the market price. So for our calculation, it's the $2.25 that we just calculated divided by the $45 per share price that is given in the exercise. Dividend yield is expressed as a percent. If your company doesn't pay dividends at all, the dividend yield would be 0. 5% is a pretty high dividend. Remember, there's two different ways you can make money in general by being invested in stock. One is through receipt of dividends, and the other is through price appreciation or growth of the cost, the value of that stock. So if you're making 5% already on dividends, that's a pretty good return, especially if the price of the stock has gone up, that then gets added to that. We are out of time, but we have finished this exercise. So, and thank you all for being here and for being here throughout the semester. If you run into any questions, as you know, Tuesday is officially a class day. You're welcome to come see me or email me or stop into Zoom or whatever you need to do to get your questions answered. And good luck on the rest of your semester, both for this class and whatever else you have on your schedule. Happy holidays to everybody, and please let me know if I can help in any way. I hope to see most or all of you back in January. January semester starts on a Tuesday because Monday the 17th is Martin Luther King Jr. Day. So we start on Tuesday the 18th. Any questions as we wrap up? Okay.